What's going on, everybody? Chris here from Project Option, and welcome to the newest options trading strategies video. So in this video we're going to talk about the bullish strategy of the covered call. Now, a covered call is a very common strategy among long stock investors because it's a strategy that allows you to collect premium without adding any risk to your long stock position. So let's get into it. So let's take a look at the covered call strategy characteristics. So covered call writing is a strategy that consists of selling a call option against 100 shares of long stock. Now, the strategy is common among long-term investors who wish to enhance their yield on shares of stock that they already own. Now, that's because selling a call against 100 shares of stock actually gives you some downside protection and actually allows you to profit if the stock remains flat over a certain period. Now, those luxuries come at the cost of capping the upside profit potential on those long shares. So the maximum profit potential of a covered call is the short call strike price plus the call credit you receive minus the share purchase price times 100. So there's a lot going on there, but do not worry. We're going to go through in-depth examples so that you understand each of these characteristics. So the maximum loss potential is the share purchase price minus the call credit times 100. So you can see that collecting a credit from selling a call actually reduces your maximum loss potential, because if you didn't collect any premium, your maximum loss on your shares is just the amount you pay for the shares times 100. So for the expiration break-even price, it's going to be the share purchase price minus the call credit you receive. Now, the estimated probability of profit for any covered call strategy is greater than 50% because since you're collecting a premium from the call, that's actually adding some downside protection, which means your shares of stock can actually decrease in price a little bit and you can still not lose money. So for that reason, the probability of profit for a covered call is higher than 50%. Now, after expiration, if the short call is in the money, a covered call trader will essentially have their shares called away. Now, that's because a short call assignment results in you selling 100 shares of stock at the call's strike price. So since you already own 100 shares of stock, if you're assigned on the short call, you'll effectively sell your shares of stock at the short call's strike price. Now, since a covered call includes a short option in the strategy, you do have assignment risk if the short call is in the money before expiration, as you can be assigned early on that short call. Alright, so let's take a look at a covered call example trade and basically run through all of those characteristics that we just talked about in regards to a real example. So here we see different strike prices and the prices of the calls associated with those strikes. Now, let's say at the time of these option prices, let's say the stock price is trading for $75. So to construct a covered call, we'll buy 100 shares of stock for $75 a share, and we'll sell one of the 80 calls for $3 in premium. So we're buying 100 shares of stock at $75, we're selling the 80 call, and we're collecting a $3 premium from selling that call. So let's go ahead and take a look at the expiration risk graph for this particular covered call position. Alright, so let's take a look at this profit and loss graph. So the dark line there represents the profit and loss of the covered call position at each stock price at expiration. The gray dashed line represents the profit and loss of just the long stock position of 100 shares. The green dashed line represents the covered call's break-even price, and the red line represents the short call's strike price. So what I want you to notice here is that at any stock price below $80, the covered call position is going to perform better than the long stock position because we collected premium from that short call. So for example, if the stock price falls to $65, the profit and loss on the long stock position is going to be negative $1,000. Now, that's because if we buy stock at $75 and it's worth $65, we have a $10 loss per share, and since we're long 100 shares of stock, the loss is $1,000. Now, however, we can see that the covered call position is not down $1,000 at $65. Now, that's because we collected a $3 premium from the 80 call option, which means at $65, the covered call is going to be down only $700 because we're going to be down $1,000 in the long stock position, but we're going to have a $300 profit on the short 80 call. So that short call provides a little downside protection when the stock price falls. Now, as you'll notice, the break-even price of the covered call is actually $72, even though we bought shares at $75 a share. That's because we bought 100 shares of stock for $75 per share, and we collected a $3 premium for selling the 80 call option. So selling that call option gives us a little bit of downside room. Now, when the stock price is trading for $80, we're going to have a profit of $800 on the covered call position and only $500 on the long stock position. So if the stock price is right at our short call strike, we're going to have a $5 profit per share plus a $3 profit from the short call option. And if we multiply both those figures by 100, we get $500 of profit on the long stock and $300 of profit on the short call option. So at $80, the short call will expire worthless, and we'll have a profit on both positions. Now, at any price above $80, we can see that the covered call's profit is capped at $800. Now, that's because at any price above $80, that short 80 call is going to cap our profits on the long stock position, and we're not going to be able to make any more money. So, for example, if the stock price goes to $90, we're going to have a $15 profit per share on our long stock, but we're going to have a $7 loss on our short call position because that 80 call is going to be worth $10, and we sold it for $3, which means we're going to have a loss of $7. So the $15 gain on the shares minus a $7 loss on the short call brings us to a net profit of $8 times 100 gives us a net profit of $800. So at any stock price above $80, which is our short call strike price, our profit will be the same. So that's the real risk of a covered call, is that the stock price explodes to a price higher than your short call strike, and you miss out on those gains because by selling the call option, you've agreed to cap your upside. Alright, so let's go ahead and take a look at a couple example trades so that you can see how a covered call performs relative to a long stock position. So here's the setup of the first example trade. The initial stock purchase price is $121.45, and we're going to look at selling the 125 call that expires in 74 days. Now we're going to collect $1.41 for selling that 125 call, which means our break-even price on this covered call strategy is $121.45 minus the credit we received from the call of $1.41, and that brings our break-even stock price to $120.04. Now our maximum profit potential in this case is the strike price of $125 less our effective share purchase price, which is essentially the same thing as the break-even price. So $125 minus $120.04 gives us a maximum profit potential of $496. So our maximum loss potential is the effective share purchase price, which is the break-even stock price, of $120.04 times 100, which brings our maximum loss potential to $12,004. Now that maximum loss potential only occurs if the stock price falls to zero in the next 74 days. So that's a very rare scenario, but it is worth a mention because it can happen. So let's go ahead and take a look at how this covered call position performs through time. So at the top of this graph, we're looking at the stock price changes, and we're looking at the stock price relative to the short call strike price and the covered call's break-even price. And in the bottom of the graph, we're looking at the profit and loss of the long stock position by itself and the covered call position, which includes the long stock position and the short call. So as we can see here, the stock price just ripped right through the short call strike price and traded all the way up to around $135 and stayed above the short call strike price through expiration. Now if we look at the profit and loss of the two different strategies, we can see that the long stock position has no cap to the amount of profit that it has, but going into the covered call position, we know that the maximum profit is $496. So as we can see here, when the stock price exploded, our covered call position's profits were capped right around $500 because there's only so much you can make when you have a covered call position. So this is an example of how if the stock price explodes, the long stock position by itself will do better than a covered call. All right, so example number 2, we're going to look at a covered call position that produces profits when the stock price remains flat and doesn't really go anywhere. So here's the setup. The initial stock purchase price is $116.45, and we're going to look at selling the 120 call that expires in 53 days. So we're going to collect $5.80 of premium from that short 120 call, which brings our break-even stock price to $116.45 minus $5.80, which brings our break-even price to $110.65. Now our maximum profit potential is the short call strike price of 120 minus the effective purchase price of the shares of 110.65 times 100, which brings our max profit to $935. Now our maximum loss potential is the effective share purchase price of 110.65 times 100, which is $11,065. Now that max loss potential only occurs if the stock price falls to $0. So let's go ahead and take a look at how this covered call performs through time. All right, so in the top of the graph, we're looking at the stock price, the short call strike price, and the covered call's break-even price. And on the bottom part of the graph, we're looking at the profit and loss of the long stock position and the covered call position. So what I want you to notice here is that the stock price is, the stock price is relatively flat over this entire period, and it pretty much trades between the short call strike price of 120 and the break-even price of 110.65. Now, when you look at the profit and loss of the two strategies, we can see that the covered call position is performing better than the long stock position pretty much the entire period. And that's because the covered call position has steady profits from the decay of the short call option that we sold. So this is just showing you that when the stock price remains flat, a covered call position will perform better than a long stock position because the covered call can profit from the short call. Now, at expiration, we can see that the stock price is between the short call strike price and the break-even price, so it was profitable overall. However, the long stock position by itself came out short with a profit of $0 because the long shares ended at the same exact price that they began at. So if you just bought shares in this case, you didn't make any money, but if you would have sold a call option against your shares, that premium actually led to profits overall at the end of the period. So in fact, since we collected $5.80 for selling that call option, the profit and loss was around $580 at expiration, while the profit and loss on the long shares was $0. So this shows you how you can make money with a covered call if the stock price remains relatively flat or even decreases a little bit over the period. All right, so let's look at example number 3, which is a defensive covered call. So let's take a look at a covered call that is implemented in a defensive manner. Now, a defensive covered call basically means that you're selling a call option against shares of stock because you believe that the stock price might fall slightly in the near future. And selling a call against your stock will give you a lower break-even price and some downside buffer. So here's the setup. So the initial stock purchase price is $119.99, and we're going to look at selling the at-the-money 120 call that expires in 37 days. Now, for selling that 120 call, we're going to collect a premium of $2.58, which brings our break-even stock price to $119.99 minus $2.58, which is $117.41. Now, our maximum profit potential on this trade is 120, which is the short call strike price, minus 117.41, which is the effective share purchase price, times 100, which gives us a max profit of $259. Now the maximum loss potential is the effective share purchase price of $117.41 times 100, which is $11,741. Now again, that max loss only occurs if the stock price falls to $0, which essentially means the company just went out of business. So it's a very unlikely scenario, especially if you're trading covered calls on blue chip stocks or stocks with very solid companies around them. All right, so in the top part of the graph, again, we're looking at the stock price, the short call strike price, and the covered call's break-even price. And in the bottom part of the graph, we're looking at the profit and loss of the long stock position and the covered call position separately. So as we can see here, right off the bat, the stock price rallied a little bit to $122.50, but then fell down all the way to $110 per share. Now, if we look at the covered call profit and loss relative to the long stock profit and loss, when the stock price fell to 110, the long stock position was down about $1,000. However, the covered call position was only down $750, and that's because as the stock price decreases, that short call is going to decrease in value as well. So by selling that call option, we actually have profits coming in from that short call that offset our losses on the long stock position. So when you compare the covered call and the long stock P&L over this entire period, we can see that the covered call performs better than the long stock position the entire time, and that stems entirely from the premium that we collected from selling the call option. So if I recall correctly, we collected about $2.50 from that call option, and as you can see, the covered call performs about $250 better than the long stock position over this entire period. So this just goes to show that if you're in a defensive state and you want to add some downside protection to your long shares, one thing you can do is you can sell a call option against your shares, and that will provide some downside protection should the stock price decrease. Alright, so now that we've talked about covered calls, you may be wondering, how do you select a call strike to sell? Well, it all depends on your outlook for the stock, and there really is no one right answer. So let's go through some guidelines and see if we can figure out how you can determine which call strike to sell based on your stock price outlook. So first of all, let's say you think the stock price will increase significantly. Well, my answer to this is, if you have such a bullish outlook, it may not make sense to sell a call against your shares because doing so caps your upside potential when the share prices increase. So if the stock price surges in value, you don't want to be short a call, you don't want to have a covered call, because that's going to limit your profitability on the upside. So if you're extremely bullish on a stock, it may not make sense to sell a call against it at all. Maybe you just hold the long shares. Now, if you think the stock price will increase slightly but not significantly, you may be able to sell a call with a 25 or 35 delta. So a significant stock price increase could be defined as a 1 standard deviation move, which is wherever the 16 delta call is. So if you think the stock price is not going to move to the 16 delta call, maybe you sell the 25 or 35 delta call. Now let's say you think the stock price will remain relatively flat and you want more protection by selling a covered call. So in this case, if you want downside protection, you may want to sell a call with a delta of 40 to 50 because that's going to provide you the greatest profit potential from extrinsic value, and that's also going to give you the greatest credit and therefore provide you with the greatest downside protection. Now let's say you think the share price will fall significantly. Well, with such a bearish outlook, it may not make sense to be trading a covered call at all because a covered call is a bullish strategy, and if you think the stock price is going to fall, you're actually bearish. So the covered call does not make sense in that scenario. Alright, so let's recap the main concepts from this video. So covered call writing is a bullish strategy that consists of selling a call against 100 shares of stock. Covered calls have limited profit potential, but a higher probability of profit than simply buying shares. Additionally, the premium received from the call provides some downside protection. To close a covered call before expiration, the long shares can be sold and the short call can be bought back at its current price to lock in profits or losses. Now this can be done in one transaction. Now on a stock that remains relatively flat, a covered call position will outperform just buying and holding shares because as we've examined in some of the examples, when you put on a covered call, you're actually collecting premium from that short call, which can be a profit driver if the stock remains flat or even decreases slightly. And lastly, if the short call is in the money, a covered call trader faces early assignment on the short call, which would result in the long shares being sold at the short call's strike price. So if you are assigned in your short call, you're effectively just selling your shares at the strike price of the call, but you're also going to keep the premium that you sold, so it's not such a bad thing after all. Thank you for watching this video, everyone. If you enjoyed this video, please go ahead and subscribe to our YouTube channel so that you can get all of our newest videos as they come out.